Hey, what's up, stock compounders? Brad here. So today I want to share my highlights from a Guy Spier talk with the Kolkata Investor Group. 2 weeks ago is when Guy Spier did this. To be honest, I wasn't anticipating all that much from this talk. I've been, as you guys know, devouring Monish Pabrai Q&A sessions, and I didn't have the highest expectations for this Guy Spier talk. But to be honest, I enjoyed this more than most of the Monish Pabrai Q&A sessions that I've watched. I found Guy Spier very candid in his answers to these participants in the knowledge session with the Kolkata Value Investors Club. So let's jump right in to my highlights from this talk. Guy Spier kind of leads off saying, I don't think I would have become an investor if I had not discovered Warren Buffett. Spier was disgusted by much of what took place as an investment banker. So, I think I've seen Nick Sleep say something similar. He was a bit disillusioned in his investment career, happened to attend a Berkshire Hathaway annual meeting, and it really opened up this whole new world for him, where he could see the possibilities of operating in a positive sum game that Warren Buffett was able to create for himself, as opposed to a zero-sum game, which is what seemed like a lot of Wall Street operates under, this zero-sum game where you're benefiting at the cost of others, at the expense of others. So, we get to define this game, which is such a cool thing about investing. We get to select carefully which games we want to play and which games we don't want to play. And that was just a reminder of that Guy Spier brought up. He talks about the art of cloning a little bit and how, it's a subtle and difficult one. Of course, we can't clone Buffett just by drinking Diet Coke and eating peanut brittle, right? There's things that you can clone that actually will help you improve as an investor. There's also a lot of noise that, we can safely ignore as we model these great investors to become better investors ourselves. So it's difficult. It's difficult to find the signal in the noise of what is worth cloning. Spier mentioned Buffett's greatest investment in terms of dollars. Sorry, guys, let me just reset this here. In terms of pure dollars made is a tech stock, okay? Something Buffett avoided for many, many years, tech companies. And of course, his greatest investment in dollar terms is Apple. So, when Guy Spier realized that, it really forced him to reevaluate how he's making investment decisions, what kinds of companies he's investing in, and perhaps more importantly, what kinds of companies, what industries he's completely excluding from the portfolio. And a big thread of this Q&A with the Kolkata Value Investors Club is this shift in Guy Spier's framework from an old world economy portfolio to more of a new world economy portfolio, and how all of these tools that Guy Spier honed over decades as the fund manager at Aquamarine are less and less useful in the new world economy. So that was really a thread, and I found that quite fascinating to hear Guy Spier talk that way in such a humble way that, in order to stay competitive, in order to really serve his investors, it's imperative that he learns about, new technologies, things like blockchain, artificial intelligence, all of these emerging industries that are really going to transform the investment landscape and disrupt those old world companies. That was really a theme that Guy Spier shared. And his next point really gets into that. The most interesting companies are not showing any income. Okay, that right off the bat is quite intriguing. The reason they aren't showing any income is they have some very extraordinary investment opportunities, and therefore they take every penny they make and reinvest it back into the business. Now, this reminds me of what Mohnish Pabrai was talking about recently with the big tech companies, both in the US and in China, and how if you look at the balance sheet, most of the big tech companies are flush with cash, right? They have a very large net cash position on the balance sheet. But the couple that Pabrai thinks are perhaps the best bets over the next 10 or 20 years actually have net debt on the balance sheet, and that's Amazon and that's Tencent. And the reason they have a net debt position is because they have these great opportunities for reinvestment. Okay, if they have cash sitting on the balance sheet, that's not generating returns. That's more of a kind of defensive play. Whereas these companies that have great offense opportunities like Amazon and Tencent, they would much rather borrow money at these very low interest rates than to earn low rates on a bunch of cash sitting on the balance sheet. So those kind of line up what Guy Spier is saying here and what Mohnish Pabrai talked about recently. He goes on to say traditional approaches to cash flow and income statement analysis are just not going to work in those areas. Okay, in areas where these companies have extraordinary reinvestment opportunities, such as the tech space. If you are focusing on buying things that are statistically cheap, right? This is statistically cheap from, say, a Ben Graham perspective, price to earnings, price to cash flow, you may actually find yourself defining your investment universe away from the places that are the most interesting places to look. This relatively small number of people, he's talking about these incredible entrepreneurs mainly based in Silicon Valley. Of course, not limited to Silicon Valley, but there's a hub of these incredible entrepreneurs in Silicon Valley. This relatively small number of people have understood the power of software to eat the world. I believe that's something Mark Andreessen said a number of years back. And 90 to 95% of the enormous opportunities that exist on the planet exist in and around those people. If you're not there, then you're in a desert. And he mentions this throughout the talk. If you're wandering through the desert and your only tools for finding compelling investments are kind of looking at these through these statistically cheap lenses, you're likely to find opportunities that will turn out to be value traps. Okay, they look cheap, but they're cheap for a reason. They're cheap because they're missing that growth potential of these software companies that are eating the world and will continue eating the world. The competition from the world of tech and the cloud is coming at you in ways that you can't even start to imagine. So Guy Spier, he is not resting on his laurels. If you look at his current investment portfolio for Aquamarine, it's very well established, dominant companies. I'm just going to pull it up real quick in ticker, just to give everyone a sense for Guy Spier's current portfolio. Sorry, this is taking a moment to load. Track investing gurus. Aquamarine Capital Management. So here's Guy Spier's portfolio: Berkshire Hathaway, Indian Energy Exchange, American Express, Bank of America, MasterCard. So, you know, there's a lot of well-established players here who have been dominant in their industry for, you know, in some cases, decades. We do have a few new holdings. Twitter is something he added not that long ago. Alphabet, I believe, as well. Just small positions there. Alibaba and Prosus doesn't show up here, but Alibaba and Prosus are his most recent additions to the portfolio. And if you look at Prosus, that's really largely exposure to Tencent in China. And Tencent really seems to be at the forefront of this emerging economy, right? They have a lot of exposure to these new economy companies. So I think, you know, that's one example of how Guy Spier is shifting his portfolio to have exposure to these software is eating the world type businesses. Let's see. Right, much of the knowledge I've gained over the last 20 years is not that useful anymore. Okay, so again, a very humble statement from Guy Spier. There are many companies in that space related to software and cloud. There are many companies in that space that represent enormous bubbles. Okay, so Guy Spier is not advising us to, you know, assemble this list of kind of new world companies and just throw darts and you know, play it like that. We of course still have to be mindful of valuations. Okay, we can't pay any price for these incredible businesses. We have to be mindful that most of them are probably in bubble territory. So, you know, how do we find that sweet spot between incredible emerging businesses and paying a reasonable price? That's really the game as Guy Spier sees it. The next section of the Q&A he gets into is how do I mitigate risk in my portfolio? So the question that Guy Spier asks himself with regard to risk is the company doing well for all of its stakeholders? The best, and this is a quote from Charlie Munger, the best way to succeed is to deserve success. So are these businesses composing them or you know, acting in a way that they deserve success? And I think that's a very smart question to ask. Is a company doing well for all of its stakeholders, right? Its employees, its customers, its suppliers, everyone that it interacts with. And Guy Spier mentions Facebook as a company that, you know, he really questions whether they're doing well by all of their stakeholders. And, you know, pretty strong statement here from Guy Spier on Facebook. He says, perhaps Facebook is the new tobacco. And that really gets your attention. He says, yes, Facebook is so absolutely wonderful at connecting people. But there happen to be teenage girls who will develop eating disorders, and there happen to be victims of pedophilia and other criminal gangs who can organize across Facebook's properties. It seems to me a very analogous situation to tobacco, where many people enjoy smoking cigarettes, but then there's just those people that it kills every now and then. Now, I struggle a little bit with the, it seems quite extreme to compare Facebook to tobacco. You know, it'd be really interesting to see a debate between Guy Spier and Gary Vee. Gary Vee, you know, is often asked about social media and how it's impacting young people, how you get the social media addiction. And Gary Vee really points out, social media doesn't change people. It exposes people. Okay, so there's kind of two ways to look at Facebook and these other social media companies. The truth is probably somewhere in between. But then Guy Spier goes on to highlight a couple of companies that he thinks are really model citizens in terms of doing well by all of their stakeholders. He mentions McDonald's and he mentions Coca-Cola. And I do take issue with those as examples of companies doing well by all of their stakeholders. I don't know how many of you have seen Super Size Me. It was a documentary put out by someone who decided, well, what if I just eat McDonald's for 30 days? Okay, and obviously that's an extreme example. But my sense of both Coca-Cola and McDonald's is that they're not doing all that well by their customers, okay? Coca-Cola, I mean, I'm sure they've diversified their products. There are probably healthy beverages that Coca-Cola sells. But if I just think about, the main products for Coca-Cola, like a can of Coke, it's not good. It's not healthy. Okay, I feel very confident in saying that that's a true statement. Same for McDonald's. I look at what McDonald's serves its customers, and it's not healthy, right? It's not doing its customers a service in terms of providing health through healthy food. So I take issue with that. I feel like a lot of value investors kind of gloss over that, which I find odd. Perhaps a lot of investors have drank the Kool-Aid, right, from great investors like Warren Buffett and other incredible value investors who have owned Coca-Cola, have owned McDonald's. Guy Spier even says this. He was talking to a friend of his who owns Facebook. And of course, this friend who owned Facebook kind of took the opposite side that Guy Spier took. And of course, when we own something, that introduces biases, right? We want to see that company in the best light. We want to look for reasons that company is doing good in the world. We want to really focus on those things and not look at what may be the warts, what may be the bad behaviors. So I think a lot of value investors, because they've studied Coca-Cola as one of the great investments from somebody like Warren Buffett, it's easy to kind of gloss over perhaps some of the health implications of Coca-Cola products, and I would lump McDonald's in there as well. So I do take issue with that. I perhaps have a contrarian perspective that Coca-Cola and McDonald's may not be doing well by all of its stakeholders. The next point Guy Spier gets into is I've gone through an extraordinary learning curve on position sizing. I found this very interesting. I have found it far easier to go through ups and downs in the portfolio because I've gotten far wiser on sizing positions. And I don't hear a lot of investors talk about position sizing, so that's what made this particularly intriguing to me. Guy Spier likes to start a position with somewhat under 5% of the portfolio, which is different than Monish Pabrai. Pabrai likes to have around a 10% bet as like a full conviction position. And he doesn't necessarily need to build that up. If he gets a fat pitch, he's looking to deploy somewhere around 10% of assets under management into that. It looks like Guy Spier is quite a bit under that, somewhere around 5%, maybe even less, 4 or 5%. Start a position somewhat under 5% and then let it and grow it to a 5% position. and then let it ride as long as I can. Okay, so Guy Spier, if you look at how quickly the portfolio turns over for Guy Spier versus someone like Monish Pabrai, Guy Spier is very good at sitting on his hands, watching paint dry, letting these businesses that he owns compound his capital for him, rather than, trying to do the musical chairs thing where he's continuously trying to find the best place for that capital to be parked, which I resonate more with, at least. Maybe I'm a little bit lazy, right? And so maybe that's why I resonate with this. But it also makes sense to me that, and if you studied compounding, and if you understand, you got to pay a tax hit when you sell a position. There's a lot of benefits to finding the jockey that you want to be partnered with over a decade or more, rather than continuously tinkering with the portfolio. And Pabrai seems to be coming around to this as well. He says, my 20% positions are positions that started off as 5% or 4% positions. That idea of getting position sizing right and then leaving the portfolio alone has been of extraordinary value to me. Okay, so according to Ticker, he doesn't have any 20% positions, but he's got a couple 16% positions, 14, 13%. So these are definitely, significant positions in his portfolio, these top 4 or 5 positions. But he didn't start that way, right? He didn't start with these 13, 14, 15% positions. Looks like he wants to make about 20 bets that are 5% or so at cost, and then to just let those ride. And it sounds like to avoid the temptation to trim those as much as possible, especially, if it's still a great business, if it just continues being a great business, leave it alone. Don't trim it just because it gets to some percentage of assets under management. And he also really learned that lesson with Crystal, which would be maybe twice as big as the entire fund today if he would have just left that alone. So that was a big learning from him, position sizing. How do we value new economy companies? Okay, this is a question he got, which is very relevant, right? If these are the companies that he really thinks is where the growth in his portfolio is going to come from, how does he value these things? If the old valuation metrics don't really work with these newer economy companies. So one idea is to look at the lifetime value of the customer. Okay, what does it cost the company to acquire the customer? What is the profitability of that customer over time? Knowing that when the business is growing rapidly, it may not be showing any earnings or profits. So this is looking at these longer term metrics that aren't going to show up quarter to quarter in the financial statements. So that's one example of how to look at, am I overpaying for these businesses, or is this a reasonable price to be paying? What is the lifetime value of the customer? He then talks about Naspers. The Naspers management team talk through their investments in a very clear and open way that would make sense to someone like you or me. So the question was, how do I get involved with these new economy companies? Can I just, find a fund manager that's quite well versed in this area? How do I get started? How do I get into this industry if I can't really wrap my head around it currently? And Guy Spier's response was to find, people who really understand these kinds of companies and are really, neck deep in this industry, in tech, in cloud, in artificial intelligence. And Naspers, also Prosus, that management team is a management team that has been steeped in that arena for decades. Right? They first bought Tencent in 2001, so 2 decades ago. And Guy Spier, that's one way he found to get exposure to the new world economy, the new world economy companies, was through Prosus, which he talks about, not specifically in this talk, but in a previous talk that he bought Prosus. He says that company has become a position in my portfolio because I'm very confident of the ways in which they're investing and their capacity to explain it to me. He's next asked about, well, I guess the questioner kind of implied that the world is zero sum. Okay? And Guy Spier, does not see the world as zero sum. Certainly there are some aspects of the world that are zero sum where the gains of one person or one party are at the expense of another party. But Guy's experience is there are plenty of places where 1 + 1 = 3 or 1 + 1 = 11. And as investors, Naval really talks about this as well, Naval Ravikant, how investing, the best investors have figured out games to play that are positive sum, okay, not zero sum. And Charlie Munger talks about this as well in different words. We're looking for Lollapalooza effects, where 1 + 1 + 1 = 27, right? Where there's these ecosystems that really support one another, and every player involved in that ecosystem wins. Okay, they come out ahead. I think that's really important in terms of identifying compelling investment opportunities, is to look through that lens of, are all of these stakeholders better off because they've teamed up with this business? And then Guy Spier would say that gambling, for example, is zero sum. And that's one of the reasons Guy Spier doesn't invest in the gambling industry. Okay, we're coming down the pike here. When it comes to cryptocurrencies, so Guy Spier is asked about cryptocurrencies. What's his take on that? He says, I would love to be able to dismiss it as tulip mania, as rat poison squared, like what Charlie Munger referred to it as. I do think that's wrong. Guy Spier thinks that dismissing crypto is a mistake for investors. The idea that we can trust a counterparty that we've never met with regards to payments is a mind-blowing innovation. Okay, so this idea, and Naval also talks about this. I think he talked about it in his recent podcast with Tim Ferriss and Chris Dixon. So for millennia, banks have been an essential ingredient when it comes to payments between two parties that don't know each other, right? There's no trust established between these parties that don't know each other, so they need to operate through this third party that can serve as an intermediary. When it comes to blockchain and crypto, you can send payments to people that you don't know in a trustworthy manner. Okay, where you don't need to be able to trust that other party, and that is revolutionary. Guy Spier says it's as revolutionary as HTTP protocol back when the internet was just getting started. There is also no question in my mind that many cryptos and experiments with blockchain today are not going to succeed. Okay, so there's a big difference between saying, blockchain, crypto is going to revolutionize the world, and saying, I need to invest in crypto and blockchain now, or I'm going to miss out on this huge potential upside. There's a big difference between those two things. And clearly Guy Spier is in the camp where he knows he needs to make efforts to understand blockchain and crypto because a lot of what's in his portfolio now stands to be disrupted by that innovation of blockchain. But what he's not saying is that he feels compelled to invest in crypto from a, plunking down money perspective. He knows he needs to invest from an education perspective, not from a financial perspective. From a financial perspective, much of what we're seeing in crypto is likely going to zero. Okay? So it's really important to make that distinction. And I think a lot of what people argue about on Twitter in many different channels around crypto and blockchain is confusing those two points of view. For me to determine what will succeed and what won't is too hard. So Guy Spier doesn't have any investments directly in cryptocurrencies right now because it's too early to tell what's going to succeed, who is going to win in that game and who isn't. Coinbase. So he talks about Coinbase in the US is generating an enormous amount of attention. People come to the conclusion that no matter what cryptocurrencies succeed, Coinbase will be at the center of it. That's kind of the bullish argument for Coinbase. Committed to fully complying with US regulators. That's kind of how Coinbase stood out as an exchange. Early on, they said, hey, we're going to be above board. We want to be, we want to follow all US regulations when it comes to buying and selling cryptocurrencies. They're really selling the pickaxes and the jeans during the gold rush. Okay, that's one way to see Coinbase as it relates to the crypto industry. Is they make money regardless of which cryptos win or lose, and that's a very compelling play. I think that's probably part of why Hayden Capital bought into Coinbase recently. You can go to Hayden Capital and read the Coinbase thesis from Fred Liu, I believe, is the manager over there at Hayden Capital. But Coinbase, it's an investment that I'm looking into. I haven't done too much work yet, but it's on my short list of companies to kind of dig into. I think it is revolutionary, but I still don't think it's investable for my fund. So this is Guy Spier talking about cryptocurrencies. I take it very seriously. It is my responsibility to look at these things very seriously. And that's, a very different point of view than how most fund managers talk about cryptocurrencies. The people who dismiss it out of hand, my respect for these people is diminished because I don't think that's the right way to approach it. Now, to kind of defend Charlie Munger a little bit, and Guy Spier talks about this as well. If you're Charlie Munger and you see, your grandkids getting involved in crypto, it may make sense to relate it to call it rat poison squared, okay? To have very strong words to discourage people from, putting a bunch of money into crypto. I forget exactly how to frame it, but if you avoid something that's a home run, there's really not much damage that does to you, right? There's no called strikes on Wall Street. So if you miss a grand slam that's okay. The danger is in swinging for the fences at something that doesn't work out. So I think what Charlie Munger is doing isn't so bad in trying to discourage people from plowing a bunch of money into cryptos, particularly because a lot of these things are going to go to zero in all likelihood. So, if you look at it through that lens, what Charlie Munger is saying makes sense. But, as an investor who's responsible for other people's money, right? As a fund manager like Guy Spier, who's responsible for managing other people's money, the idea of dismissing crypto and blockchain, he doesn't think is responsible, because there's a lot of disruptive potential coming at, much of what he holds currently in his portfolio. So there's a responsibility there to understand what's coming. Let's see. Start trying to understand how the world has changed and where it's moving. So Guy Spier points out this guy, James Courier. Okay, James Courier is a venture capital investor through NFX, which is short for Network FX. Network FX. He wrote the Network FX Bible. And I actually reached out to James Courier on Twitter. He's very responsive, which is fantastic. But James Courier points out network effects can be very powerful, but not all network effects are the same. Understanding the nuances is essential for building network effects into your own products. They're also essential for, vetting different businesses, different public companies, to try to figure out which might be stronger than others, which may be more durable than others. To date, we've identified 13 different kinds of network effects listed in order of strength. Okay, I love lists like this. So you get down from physical protocol all the way down to language, belief, and bandwagon networks. Okay, and there's a lot of examples of companies that fit into each of these types of network effects. And this is a cool map here. You start at the center from physical, and then it kind of moves out, and you see social, from direct down to social. So this is something I want to dig into for sure. But you can see down at the bottom here, language, you got Google, beliefs, currencies, and religions. Obviously, there's cryptos that fit into currencies. And we've seen just the immense belief that some of these crypto backers have in different cryptocurrencies. And you've also got the bandwagon networks, which are Slack and Apple in these examples. But this is a book that was put together in part by James Courier. It's available for free on their website, nfx.com. So this is something that I really want to pour some energy into. So that's a cool resource that I picked up from this Q&A. James Courier also points out some networks keep getting more valuable as they grow, but some top out. And examples of a couple different companies that top out at a certain point, Uber and Lyft are given as the examples, where they top out at a certain saturation point, where the added value of having more drivers or more riders tops out, right? So that's interesting. There's no benefit to having extra cars or drivers at a certain point. Those are not as interesting of businesses as those that don't top out. Right, so James Courier is trying to make these distinctions, to parse out these nuances when figuring out what companies to invest in. So I think that's pretty much everything from this talk, guys. Fantastic Q&A session from Guy Spier with the Kolkata Value Investors Group. Yeah, so definitely check this out. It's an hour and 42 minutes, well worth your while. And yeah, really impressed by how candid Guy Spier was in a lot of these answers. You know, he's not just kind of regurgitating what he's said in previous Q&A sessions. He's really trying to pull, you know, in real time where he's at with a lot of these different topics as it relates to his portfolio and his investment framework. So awesome stuff. I hope he does a lot more Q&A sessions in the near future. So thank you, Guy. And with that, I will leave you guys till the next video. Take care.